Welcome back to BullionIQ, the channel where we cut through the noise, the hype, and the surface-level narratives and actually break down what's happening in the financial markets, especially crypto, from a strategic, analytical point of view. If you're here because you want real understanding instead of clickbait price predictions, you're in the right place. Today, we're going deep, not just surface catalysts, not just one or two bullish headlines, but every single realistic avenue through which XRP's price could meaningfully reprice higher over time. This is not about overnight pumps. This is about structure, liquidity, regulation, and incentives, the things that actually move markets. Now let me ask you something important right at the start. If XRP's price has been boring lately, moving sideways while the headlines keep getting more bullish, does that mean nothing is happening? Or does it mean something big is quietly building underneath the surface? Because historically, markets do not move explosively when everyone is watching. They move when positioning changes silently, liquidity tightens, and demand gets redirected behind the scenes. And that's exactly the framework we're going to use today. What I want to do in this series is explore XRP from every angle that actually matters. We're talking about market cap multipliers, ETFs, Ripple's business model, regulatory positioning, dark pools, OTC liquidity, institutional behavior, and how all of these forces interact with one another, not individually, but as a system, because price is never driven by a single catalyst. Price explodes when multiple forces converge at the same time. Let's start by addressing one of the biggest misconceptions floating around in the XRP community and the broader crypto space. The idea that dark pools and OTC desks can somehow suppress price indefinitely. You'll hear people say things like, well, institutions are just trading off exchange, so price doesn't need to move. That sounds logical on the surface, but it breaks down the moment you understand how liquidity actually works. There is no infinite hidden supply of XRP sitting in the background. Dark pools are not magical black holes that absorb unlimited demand without consequence. They rely on inventory. And inventory, especially in a fixed supply asset with growing utility, eventually runs out. Yes, large players absolutely use OTC desks and dark pools to avoid slippage. That's normal. But those venues still need sellers. And when price appreciation begins, or when utility increases, or when regulatory clarity improves, behavior changes. Holders become less willing to part with their XRP at lower prices. Long-term holders lock up supply. Institutions that already own XRP stop recycling it. At that point, OTC liquidity dries up faster than most people expect. And when that happens, demand doesn't disappear. It gets forced onto public exchanges. This is why sideways price action can be deceptive. What looks like stagnation on the chart can actually be accumulation under the surface. Retail holders today control a relatively small portion of the total XRP supply compared to what institutions, custodians, and Ripple-related entities control. If even a fraction of institutional demand shifts from OTC channels to exchanges, the available liquidity simply isn't there to absorb it without repricing the asset higher. That's when you get gaps on the chart, not gradual moves. Sharp repricing events. Now, I want to be very clear here because this is where a lot of analysis online becomes incomplete. It's true that when OTC desks run low, exchanges become the next source of liquidity, but it's not the only source. Ripple itself plays a critical role in this ecosystem. Through on-demand liquidity, direct institutional sales, and potential regulatory waivers, Ripple has multiple avenues to distribute XRP, especially outside the United States. And there are even plausible scenarios where Ripple could receive permission to sell XRP directly to U.S. institutions under specific regulatory frameworks. That matters because it changes where supply comes from and how it's priced. At the same time, regulation introduces another constraint that most people overlook. Under current proposals and legislation, decentralization thresholds matter. No single company can hold too large a percentage of a digital asset and still have that asset treated favorably under regulatory frameworks. Ripple, between escrow and executive holdings, still controls a significant amount of XRP. If regulations push Ripple to reduce that exposure over time, where does that supply realistically go? The most logical answer isn't retail. It's ETFs, custodians, and institutional products designed to warehouse large amounts of XRP long-term. And this is where things start to get really interesting because once XRP supply starts migrating into ETFs, index funds, regulated custody products, and bank balance sheets, that supply effectively becomes inactive. It's not trading daily. It's not sitting on exchanges waiting to be sold. It's locked up. And every unit of XRP that gets locked away increases the sensitivity of price to new demand. That's how market cap multipliers begin to matter. This channel exists to help you understand why those multipliers happen, not just that they exist. When liquid supply shrinks and incremental demand increases, price doesn't move linearly, it moves reflexively. Each new dollar coming in pushes price higher, which then revalues the entire circulating supply. That's not theory, that's observable market behavior, and we've seen it repeatedly across crypto cycles. So as we move forward in this breakdown, keep this mindset. We are not predicting dates and we are not chasing hype. We are mapping incentives, constraints, and structural shifts, because when you understand those, price becomes the output, not the mystery. And in the next part, we're going to zoom in on one of the most powerful catalysts in that entire system, Ripple's banking ambitions, regulatory positioning, and why that could fundamentally change where XRP sits in the global financial architecture. Now let's build directly on that foundation and talk about what I consider one of the most misunderstood but potentially explosive catalysts for XRP, Ripple's move toward becoming a regulated banking entity and what that actually means in real financial terms. Because this isn't just a headline, this isn't just branding. This is about XRP moving from the fringe of speculative crypto into the core plumbing of the financial system. Ripple currently has a live application with the U.S. Office of the Comptroller of the Currency to charter a national trust bank. That alone should make people pause. This isn't a shell application, it isn't a PR stunt. Industry groups, lobbyists, and advocacy organizations have filed formal comment letters both for and against it, which tells you regulators are treating it seriously. When institutions bother to oppose something formally, it means they believe it could matter. And the OCC leadership has already gone on record saying crypto firms should be evaluated similarly to traditional applicants. That's not approval yet, but it is a massive shift in tone. If Ripple were to receive this charter, especially combined with eventual access to a Federal Reserve master account either directly or through correspondent relationships, XRP would effectively move inside the banking perimeter. That's the key phrase you need to remember. Assets inside the perimeter are treated differently. They are allowed to be held, used, custodied, and integrated into settlement systems without the same existential regulatory risk. At that point, XRP stops being just a crypto token and starts functioning as regulated settlement infrastructure. Why does that matter for price? Because banks do not operate on a buy when we feel like it model. They operate on necessity. If a bank uses an asset for settlement, liquidity management, or collateral movement, it must hold inventory. That creates baseline demand that does not disappear during bear markets or periods of low sentiment. Structural demand like that is far more powerful than speculative demand because it's persistent. This ties directly into the conversation about Tier 1 assets and collateral eligibility. While XRP is not officially labeled a Tier 1 asset today, regulators around the world are actively experimenting with allowing certain digital assets to be used as collateral in derivatives, margin, and settlement frameworks. The CFTC's pilot programs, Basel discussions, and similar initiatives are not theoretical. They are live tests. Once an asset is firmly categorized as a non-security and meets liquidity and operational criteria, the door opens for it to be used in ways that force institutions to hold it. XRP is uniquely positioned here because it already has legal clarity in the United States from a court perspective, even if some regulatory cleanup still needs to happen. That distinction matters. Regulators don't need perfection to move forward. They need enough clarity to justify risk-managed exposure. Each incremental regulatory step that moves XRP closer to collateral eligibility expands the pool of institutions that are allowed to touch it. And when institutions are allowed to touch an asset, they don't dip their toes. They allocate. Now layer that on top of what's happening with ETFs. Spot XRP ETFs are not just passive products. They are liquidity vacuums. Every dollar that flows into an ETF has to be backed by real XRP purchased off the market. And because XRP's liquid supply on exchanges is already declining sharply, those purchases have an outsized impact. This is where the concept of market cap multipliers becomes critical. In crypto, market cap does not behave like equities. There isn't deep two-sided liquidity across the entire supply. Most XRP is not for sale at any given moment. So when ETFs, index funds, and custodians start absorbing supply, each marginal buy pushes price higher, which then reprices the entire circulating supply. That's how you can see $1 billion of inflows translate into tens or even hundreds of billions of dollars in market cap expansion. It's reflexive, and it cuts both ways. But during sustained inflow periods, it becomes extremely powerful. What makes XRP particularly sensitive to this effect is how much supply is already migrating off exchanges. Data from multiple analytics firms shows exchange balances have dropped by over 40% in a short period. That's not retail panic selling, that's large holders moving into cold storage, custodial products, and regulated vehicles. In other words, supply is being locked away while new demand vectors are opening up. And this brings us back to dark pools and OTC desks. As more volume migrates into semi-opaque venues, public order books become thinner, not irrelevant. Hidden demand doesn't eliminate price pressure, it delays it. When OTC desks can't source enough XRP from Ripple, from long-term holders, or from internal inventory, they must top up from exchanges. And when they do, they don't buy in small increments. They buy $5, $10, $20 million at a time. In a thin order book, that kind of demand doesn't get absorbed, it reprices the asset. This is why the narrative of price suppression forever doesn't hold up. Suppression requires infinite supply or infinite willingness to sell. XRP has neither. What it has is a shrinking liquid float and expanding institutional use cases. That combination doesn't lead to slow, predictable price action. It leads to regime shifts. So when you hear people say XRP hasn't moved yet, understand what that actually means. It means the groundwork is being laid. It means positioning is happening before the headline moment. And historically, by the time the move is obvious to everyone, the easy gains are already gone. Regulatory positioning and ETFs as liquidity vacuums. It's time to dive into the next layer of the XRP ecosystem. Derivatives, tokenization, and real-world asset settlement. This is where the picture moves from speculative narratives to tangible financial infrastructure, and why XRP could realistically trade at levels that most retail traders haven't even considered. Let's start with derivatives. Unlike retail markets, derivatives allow institutions to leverage exposure, hedge positions, and move massive notional amounts of capital with minimal upfront liquidity. The CFTC, along with global regulators, has already opened pilot programs for digital assets like Bitcoin and Ethereum, allowing them to be used as collateral, posted in margin accounts, and traded as derivatives. XRP, once fully cleared as a non-security, fits naturally into this framework. And here's the key. When an asset becomes eligible for derivatives and margin use, it instantly creates a structural floor for demand. Institutions must hold inventory to post as collateral. That is mandatory demand, unlike retail buying, which is discretionary. Next, let's talk about tokenization and settlement of real-world assets. We're no longer in a world where blockchain is just for speculative tokens. Governments, banks, and corporates are actively piloting tokenized money market funds, tokenized government bonds, corporate treasuries, and even repo markets. To put this into perspective, the U.S. Treasury market alone is around $30 trillion, corporate bonds globally are over $125 trillion, and the repo market processes several $trillion in settlements daily. XRP, with its high-speed settlement capabilities, is being positioned to be the rail for some of these flows. Imagine even a tiny fraction of this massive global infrastructure adopting XRP-led settlement. The notional value required to facilitate it is enormous, and the token demand scales accordingly. This is where supply compression becomes a critical driver. On exchanges, visible XRP supply has already dropped dramatically. Analytics firms like Glassnode and CryptoQuant show multi-year lows in exchange reserves, even while spot prices remain relatively flat. Why does this matter? Because every new demand wave, whether it comes from ETFs, OTC desks, or institutional adoption, now hits a much smaller available float. In simple terms, fewer XRP tokens available for sale combined with growing institutional demand, rapid repricing potential. This is a classic supply-demand dynamic amplified by the structure of crypto markets. Layer 2 and Layer 3 solutions add another multiplier. On-chain burns, transaction fee burns, and protocol-level incentive mechanisms slowly but steadily shrink effective supply. Even if the absolute numbers seem small, 30 to 40 million XRP burned per year if every transaction globally occurred on-chain. It compounds over time and, combined with custody and ETFs, contributes to a tighter liquid float. Meanwhile, banks and institutions increasingly use XRP for on-demand liquidity, cross-border payments, and internal settlement stacks. Each new use case locks away additional supply. Now, let's combine all of these elements with market cap multipliers. In traditional markets, adding liquidity tends to have a linear effect. In crypto, especially in assets with concentrated ownership and low exchange supply, every new dollar entering the ecosystem can produce multiple dollars of market cap expansion. For XRP, inflows from ETFs, index funds, custodial products, and institutional adoption are already measurable in tens of millions daily. Because liquid supply is tight, the price impact is not proportional. It's amplified. This is how $1 billion in fresh inflows could theoretically drive $100 billion or more in market cap expansion, depending on liquidity constraints. A critical part of this framework that is often overlooked is how OTC desks and custodians interact with public markets. Demand doesn't disappear because trades happen behind the scenes. It just hides temporarily. When these semi-opaque venues run short on XRP, they inevitably return to exchanges for top-up buys. In a thin order book, these purchases aren't absorbed smoothly. They drive price higher rapidly. The system essentially self-reinforces. Tight supply, plus forced buying, plus high demand, plus compounding upward pressure. And let's not forget the role of global payment infrastructure. XRP isn't just competing for retail remittance flows anymore. It's being integrated into trade finance, FX settlements, and corporate treasury operations. Instant blockchain-based settlement is a major efficiency improvement over legacy systems, and banks that adopt XRP for operational reasons will naturally maintain liquidity. Each institution participating in this system is another structural buyer. Unlike speculative retail, these are long-term operational buyers. Their participation raises the floor for price while also increasing the ceiling because liquidity is constrained. To give you a concrete example, think about cross-border FX. The market is roughly $7 trillion daily. Even if 0.5% of that volume were routed through XRP-led rails, the notional liquidity required is massive. With the liquid supply on exchanges shrinking and ETFs absorbing more XRP, the system is practically engineered for price acceleration when adoption scales. And that's before you layer on additional adoption through derivative markets, tokenized collateral, or bank-level liquidity management.
Finally, there's the ecosystem effect. The XRP ledger is expanding beyond just Ripple. Multiple projects are building on top, from Layer 2 solutions to decentralized finance integrations. Each of these projects increases the demand for XRP because it acts as the underlying settlement asset. More utility equals more holders, more long-term custody, and therefore less liquid supply. This is the compounding cycle that can drive dramatic repricing over time. It's time to explore the macro-level adoption and regulatory alignment that could push XRP into a completely new pricing regime. Because even if you have strong utility and shrinking supply, the full magnitude of price moves happens when multiple layers, regulation, adoption, and market structure align simultaneously. This is where the math behind market cap multipliers meets real-world financial infrastructure.
Let's start with ETFs and index funds, which are increasingly the most visible drivers of new demand. Spot XRP ETFs are live or imminent, with multiple issuers approved under the simplified auto-effective regime. Funds like 21 Shares TOXR, Canary, Vanish, and recently Bitwise are actively buying XRP from the open market to back their products. The Bitwise Index Fund, for instance, started with $1.25 billion in assets, allocating roughly 5% to XRP, about $64 million immediately directed toward spot purchases. That's not just noise, that's capital permanently moving off exchanges into regulated products. As these funds scale, liquid supply continues to tighten, and ETFs begin to function like persistent demand engines. Each incremental buy has an amplified effect on price due to the scarcity of XRP available for trading. Couple that with the movement of large holders into cold storage, custodial accounts, and regulated products, and the visible float shrinks further. Analytics from Glassnode and CryptoQuant show that exchange balances have fallen 40–45% in recent months. In a market with tight liquidity, even modest top-up buys can create sharp price jumps. It's the combination of locked-up supply and structural demand that produces the reflexive effects we call market cap multipliers. Essentially, as more supply is taken off exchanges, each dollar entering the market moves price more than the last, creating an exponential dynamic rather than a linear one. Next, we layer on regulatory clarity. Ripple has already achieved significant wins with the SEC litigation outcome, confirming XRP is not a security under U.S. law. However, adoption by institutions requires a broader regulatory ecosystem. The CFTC, OCC, Basel Committee, and EU regulators are moving toward frameworks that allow certain digital assets to be used as settlement and collateral assets. XRP, with its growing legal clarity and operational adoption, sits perfectly within this trajectory. Once these frameworks are solidified, institutional participation becomes not just possible, but inevitable. Pension funds, corporate treasuries, and regulated financial entities can now hold XRP with confidence, creating a permanent base of demand. Now, consider cross-border payments and trade finance. These markets move trillions of dollars daily. FX alone processes roughly $7 trillion per day. Currently, most of this liquidity is slow, expensive, and fragmented. XRP's speed, low cost, and settlement efficiency position it to capture even a fraction of this market. Suppose just a single-digit percentage of FX flows or global trade finance volume migrates to XRP rails. The notional value required to facilitate these settlements would necessitate a much higher XRP price for the system to function efficiently. In other words, utility itself dictates higher pricing. Low liquid supply plus high operational demand equals structural repricing pressure, not speculative hype. Let's not forget tokenization. Governments, banks, and corporate entities are piloting tokenized money market funds, bonds, and repo settlements. XRP's ledger provides instant settlement, cross-chain compatibility, and transparency, making it an attractive candidate for these large-scale institutional experiments. Each successful pilot adds credibility, increases inventory demand, and reduces available supply for trading. Layer in additional infrastructure like the Yellow Network, which Chris Larson invested in, and you have a decentralized clearing layer connecting exchanges, brokerages, and DeFi platforms. This ecosystem expansion is subtle, but it creates additional demand for XRP as the native settlement token. All these elements converge to create a market where price is no longer set by retail sentiment. Instead, it is dictated by institutional flows, liquidity constraints, and adoption-driven demand. Even incremental inflows from ETFs, OTC top-ups, or bank settlement operations can produce outsized price effects. This is why many analysts now talk about XRP having the potential to reach multi-digit or even triple-digit price levels in the medium to long term, not because of speculation, but because the underlying financial structure requires it. Another factor that's often underestimated is supply compression through burns and ledger mechanics. While XRP burns are small in absolute numbers, around 30 to 40 million per year under maximal usage, combined with ETFs, cold storage, and institutional custody, the effective tradable float becomes razor thin. This scarcity effect interacts with market cap multipliers, making even modest inflows capable of moving the market significantly. Finally, consider Ripple's broader ecosystem growth. Beyond just settlement, the XRP ledger now supports smart contracts, DeFi applications, and Layer 2 solutions. Each project adds incremental demand for XRP. Institutions and developers building on top of XRP are forced to hold liquidity for operational needs. That's a non-speculative, utility-driven form of demand. Over time, these multiple layers, ETFs, banking adoption, tokenization, settlement flows, ecosystem growth, and regulatory alignment all act in concert. When combined with shrinking liquid supply, they create the conditions for explosive repricing, where we connect all the pieces: regulatory clarity, institutional adoption, ETFs, tokenization, derivatives, liquidity, and Ripple's ecosystem expansion, and frame them in the context of potential price outcomes and risk management. This is where the vision meets the mechanics of the market. First, let's talk about Ripple's potential IPO. Ripple, as a company, is uniquely positioned in the crypto and fintech landscape. An IPO would provide both a capital injection and increased transparency into Ripple's holdings and operations. It would also serve as a legitimacy signal for institutional investors. If Ripple IPOs, large portions of XRP holdings may be redistributed or locked under institutional control. This would further reduce the liquid supply available on exchanges. Coupled with ongoing ETF inflows, custodial demand, and bank adoption, you begin to see how structural scarcity emerges. Scarcity plus increasing institutional demand is the classic setup for a major re-rating in price. Next, derivatives and collateralization. The CFTC and global regulators are piloting frameworks for digital assets to be used as collateral and margin in regulated trading environments. XRP, once fully classified as a non-security and integrated into these systems, will not just be a trading token, but a settlement asset, a margin token, and a collateral instrument. Institutional participants in these systems cannot ignore holding XRP. They must hold inventory to operate efficiently. Each incremental adoption adds to the structural floor, while the shrinking float amplifies the upside potential. The role of global payments and FX markets cannot be overstated. Daily FX volumes exceed $6.7 trillion, and trade finance runs into trillions more. XRP's instant settlement and low-cost infrastructure allow even a small market share to translate into enormous notional flows. If 1% of FX transactions or trade finance volumes migrate onto XRP rails, the system requires a significant amount of XRP liquidity to function smoothly. This is where the idea of utility ceiling comes in. The XRP price must rise to a level that supports operational demand. It's not speculation, it's economics. Tokenization further strengthens this thesis. Governments, banks, and corporate entities are increasingly experimenting with tokenized bonds, repos, and money market funds. Ripple and its ecosystem are positioned to serve as the settlement layer for these tokenized instruments. Each use case represents incremental locked supply, which further reduces tradable XRP and increases the price sensitivity of remaining liquid tokens. Even if the numbers seem modest in isolation, the combined effect is exponential. We also need to consider supply compression. Exchange visible supply has dropped by nearly half over a short period. When combined with burns, long-term custody, ETFs, and bank settlement, the effective float becomes razor thin. The reflexive impact on price is magnified in a market where structural demand exists. Essentially, every incremental buyer, ETF, bank, or institutional participant, moves the price disproportionately. This is why analysts talk about market cap multipliers of 50x, 100x, or even higher under the right conditions. Ecosystem growth amplifies this dynamic. The XRP ledger is no longer just a settlement layer for Ripple. It supports Layer 2 solutions, decentralized finance applications, and third-party payment infrastructure. Each of these projects requires XRP liquidity to operate. As adoption grows, liquid supply diminishes, reinforcing the feedback loop that drives price higher. Lastly, we have global regulatory alignment. The arc of 2025-2027 looks favorable. Basel Committee updates, CARF MECA implementation in the EU and UK, and various Asian licensing frameworks are all moving toward accepting digital assets for settlement and collateral purposes. XRP's existing clarity in the US, combined with these developments, allows large banks and asset managers to roll out XRP-based products without fear of retroactive regulatory bans. This institutional confidence is critical. It translates into more capital flows, which are amplified in a low supply environment. So what does this mean for the price? When you combine shrinking liquid supply, structural institutional demand, ETF inflows, derivatives and collateral adoption, Ripple's banking license potential, tokenization, and ecosystem growth, you are looking at a scenario where the market could reprice XRP significantly higher. The narrative that XRP is boring today masks an underlying shift in positioning, liquidity, and adoption that could be catalytic once fully realized. Risk management is still crucial. While the upside is enormous, investors should be aware that regulatory or macro shocks can temporarily disrupt the system. However, the structural elements we've outlined, institutional demand, shrinking supply, and increasing utility, create a strong floor that did not exist in earlier cycles. The potential rewards justify strategic allocation, particularly for those who understand the systemic nature of the catalysts involved. In conclusion, XRP is no longer a speculative token in isolation. It is increasingly functioning as an operational, structural, and institutional asset. The combination of ETFs, Ripple's banking ambitions, global regulatory alignment, supply compression, derivatives and collateral adoption, tokenization, and ecosystem growth forms a perfect storm for potential price discovery. Understanding these dynamics, not just following headlines, is the key to positioning yourself in this evolving market.